Hi everyone, this is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is the Chief Investment Officer at Bleakley Financial Group, and he's the editor of the Book Report newsletter, Peter Boockvar. Thank you for joining me again.
Thanks for having me on.
Now, Peter, I want to ask you about the Fed's plan to reduce their balance sheet. Do you think that they can meaningfully reduce their balance sheet while not allowing the asset markets like the Dow and others to collapse?
I think it's doubtful, and I'll replace collapse with going lower because who knows what will happen. But if you look at what was the main driver of this bull market, which is not unusual, typically it is, and that's PE multiple expansion. And if you believed that QE and zero rates was a catalyst for multiple expansion, well, then it would be inconsistent to not think that quantitative tightening and rising interest rates would not lead to multiple contraction. So to me, that's the first step of this. So let's just say instead of paying 18 times earnings, maybe the market decides with this draw of liquidity and higher cost of capital that maybe I should pay only 16 times. That's when the market starts to become vulnerable. It's easy. Someone can put pen to paper and try to figure out what and forecast what the EPS number is going to be, but it's impossible to know what the P multiple is going to be on that. The assumption on Wall Street today is that we're going to see no change in market multiples, and I argue that you will see a reduction in market multiples as the Fed gets deeper into their tightening phase. Then, if the markets start to go down, that obviously then can have market implications. If interest rates start to go up, economic implications. If interest rates start to go up, that's going to have implications, and that's when things start to potentially, on paper, unravel, which typically happens as the Fed gets deeper into a tightening cycle. And this one, of course, is certainly unique relative to previous ones.
Yeah, the VIX is unbelievably calm on a historical standpoint. It's barely above 9. It seems, once in a while it spikes and then it ends up going lower. There's that leverage short volatility trade, which hedge fund manager Christopher Cole of Artemis Capital says it's over $1.5 trillion in size. So do you think then that the Trump tax cuts are priced in?
I think we were slowly pricing them in all throughout 2017 and then fully priced them in as we got to the end when Congress passed it. So I think there's no question that this $150 EPS number that's out there has fully taken into account the tax cuts. What it has not taken into account, because that's an all else equal number, does not take into account higher labor costs that are now beginning to happen. It's not taken into account higher interest rates, which should happen if the stock market's so right on growth. It's an all else equal number. So I would argue that, yes, we priced it in fact, many times, and I would say it's fully priced in.
Now, you mentioned higher interest rates. The Fed has talked about wanting to increase interest rates an additional 3 times, and is their projection for 2018. Do you expect them to hit those numbers, or do you think they're going to fall short?
Well, they would only fall short if there's a problem. I think if there's no problem, then they will get to those 3 hikes. But again, this is going to be a different year in terms of tightening, because 3 hikes on top of what they've done off zero, in addition to $420 billion of liquidity taken right out, the combination of that will matter. Who the hell knows when?
Now, do you think the Fed, by increasing those rate hikes, do you think that they were expecting the yield curve to be a normal yield curve that was, steepening and ascending? And it seems the yield curve instead is flattening, and it may even eventually go inverted. So how close are we to an inverted yield curve, and what, from a historical standpoint, would that mean?
Well, with the 10-year at 248 and the Fed funds at 1.5, you got to get at least another 100 basis points if the 10-year stayed where it is. So we'll have to see. Again, this time around, I don't know if we can compare a potential flattening with previous ones, but I think ignoring a flattening yield curve is probably not a good idea. Historically, sometimes it's fully inverted before there's a rollover. I mean, there's different studies and different time frames of when it matters. So right now, I think people should just be focused on the trajectory of things. But you also have the action in European bonds and Japanese bonds that are influencing the long end here. And a German 10-year at 45 basis points certainly keeps a lid on the U.S. 10-year. So I think a lot of the historical studies and relationships aren't fully applicable now.
Yeah,
that said, still can't ignore the flattening yield curve, but there are other strong influences that has kept it relatively flat as well.
Yeah, that's a great point about a historical standpoint. I mean, we've never seen this before with all these different global central banks, whether it's the Bank of Japan, the European Central Bank, all doing massive quantitative easing injections. I think there was over $300 billion a month at one point, but it looks like now the central banks are in somewhat of a tightening cycle.
Yeah, I think they really started last year when you had the Fed actually raising 3 times and beginning the balance sheet shrinkage, and you had the Bank of England that took back a rate cut, and the Bank of Canada raised twice, and South Korea raised, and you had the Bank of Japan, which was on a 80 trillion yen run rate, ratcheting that down to about 50 to 60. The ECB, even the ECB in April went from 80 billion a month to 60 last year. Now, of course, none of that mattered because it was still very early in its stage, but it started, and we've reached peak easing, and now we're going to see sort of an intensification of the tightening. Now I know the European Central Bank is still adding liquidity, but I argue that a reduction of that addition in liquidity is actually a form of tightening, because just imagine a balloon. You can still pump, if you're pumping air into the balloon, but you start pumping less air, there's still air going into the balloon, but the balloon still contracts. And I think that's what is happening now with the ECB on top of what the Fed is doing. So I estimate between the Fed and the ECB, there's going to be $1 trillion less of liquidity just from those two, let alone what I expect to be further stepping back from the Bank of Japan, more rate hikes. And as we get to the end of 2018, people have to start thinking about, okay, well, now we're closer to the end of negative interest rate policy, because you have between the Japanese and the Europeans and a few different central banks in Europe, well, they want to eventually get off negative interest rates. So $10 trillion plus of negative yielding paper, well, imagine the losses on that paper when all these central banks just decide just go back to zero. So that's what we have to look forward to the next 2 years. Next 2 years, $1 trillion out from the Fed, $600 billion less from the ECB in 2018, and an end by October, and then the end to negative interest rates. So I think people are delusional if they think that's not going to start to affect PE multiples, and at some point, decline in asset prices then starts to impact the real economy, and that's what causes the next recession. So people say, well, there's no excesses, therefore we're not going to have a recession. I'm like, well, if you look at the 2 prior recessions, they were triggered by decline in asset prices, housing, of course, and technology. And when technology collapsed, it led to a collapse in capital spending. So it's a decline in asset prices that will eventually lead to the next recession. Again, I don't know when that happens, but I think the odds grow as we get deeper into this monetary tightening.
Great analysis. I was going to actually ask you what the bull case is, since all these central banks are claiming that they're going to raise interest rates or reduce their balance sheet, what the bull case would be for a higher stock market then. I just don't really see it, and yet the stock market continues to basically defy gravity and keep moving higher.
Well, the bull case is the economy is great, and global economy is great, and we can withstand, even though debt levels are at record highs, that somehow we can withstand this monetary tightening and higher rates. And also people take comfort in the gradual nature of this tightening. It's not harsh in terms of its speed, which is true, but that doesn't necessarily make it feel better just because it's slow. So I think that's what people are taking comfort in. But again, we're historically very expensive. We've certainly been expensive, and being expensive is not the mark of an end of a run. But when you mark a very expensive market, and I define expensive where the price-to-sales ratio on the S&P 500 is above where it was in March 2000, and even digging deeper, if you look at enterprise value to EBITDA, to look at it a cash flow perspective, we're approaching the March 2000 level. So if you combine the monetary tightening with high valuations, at some point that's a toxic combination. But again, right now people are just blind to that and focused on the prospects for growth, even though, as I said earlier, I think a lot of that has already been priced in.
Yeah, I agree. I don't think, a lot of the large cap companies have just been buying back their stock using artificially cheap debt, in my opinion, to buy back their stock. They're not really growing revenues. They've been using the cheap debt for leverage buyouts as well. Do you think a lot of this credit, China, in my opinion, has a credit bubble. Do you think a good amount of that credit has leaked out of China and into other global asset markets?
Yeah, I'm sure. There's no question. It's just trying to quantify that is very difficult. So it's tough to say. I mean, there's liquidity leakage everywhere. I mean, it was through QE in Japan and Europe. There's liquidity leakage as people try to find other higher yielding opportunities. So if you believe that QE and is fungible, it doesn't matter where it comes from. It still ends up everywhere.
Do you think China is more likely to have a financial crisis sooner than any other country? Because there's been studies coming out lately from Deutsche Bank and others saying China is twice as likely because of their credit explosion.
Well, there's no debating their credit explosion. There's no debating their high debt levels. I think the question is how that unfolds. Is it possible that China sort of grows its way out and that debt to GDP levels go down, not because debt growth necessarily slows, but they'll never officially delever in the sense of debt will go down. They'll delever in that they'll try to slow the rate of growth in debt while trying to maintain a level of economic activity where the debt to GDP ratio would go down. You know, China has obviously a very controlled economy, so it's hard to say when or whether there's going to be a crisis. Maybe they just muddle through. Maybe they just paper over things. Maybe they re-equitize their bank stocks themselves. I think betting on a blow-up in China is a tough go because of that. I think you're more likely to run into issues in Europe and in the U.S. As the Fed and the ECB back away from QE. I mean, it's astonishing looking at European bond yields, and that is just a train wreck waiting to happen over the next 2 years as QE ends and negative interest rates go away. That's what people should be worried about, because China it's too tough to gauge when China will matter, but it's easier to sort of chronologically play out how Europe is going to unfold the next 2 years.
Yeah, Kyle Bass has been betting that the RMB is going to that China is going to have to do a very big RMB devaluation, and for about a year and a half, 2 years, he's been wrong. So I understand the logic of his argument. I think it's very sound, but the timing of that trade, it just hasn't worked in his favor yet.
Right. No, it's a very sound fundamental basis, but yeah, the timing is always the most difficult part of this business.
I want to ask you about the dollar now. So the dollar index has been very volatile. It's moved a lot against the euro. In your opinion, do you expect then the dollar index to continue to be very volatile going forward?
Well, it's been volatile, but it's been weak. I mean, the dollar had a terrible year in 2017 in the face of all this optimism about U.S. growth and tax reform, and in the face of the Fed being more aggressive in removing policy accommodation rather than the others. So I think that's a telling factor in its performance, and I think the dollar really can't get out of its own way, and I think people should be worried about that, and I expect this weakness to continue in coming years.
Very interesting. Since you've worked on Wall Street so long, what's your opinion of Bitcoin and this cryptocurrency? Is it a bubble, and are you participating in it?
I'm not participating in it. I'm fascinated by the whole thing. I think that originally when it was created, it was really created to be an alternative currency and another payment system archived by blockchain. And I think the price of it has become a bubble. I think the technology and the concept is great, but the price of it has become a bubble. And what was originally a very unique thing is no longer unique, because there's now 1,300, I think, cryptocurrencies, and there are now multiple Bitcoins, Bitcoin Cash and Bitcoin Gold, and there's going to be more forks of Bitcoin. So where you had this Bitcoin of 21 million limit, well, now it's not really the case because you have all these forks. So it's not a finite asset anymore that it was portrayed to be. And I think at the end of the day, a lot of these Bitcoin prices will collapse, but we'll still be left with the technology of maybe a new payment system and of course, the blockchain. So I think you just have to separate the price of these coins from the actual technology and the potential use of them.
Does this remind you of the tech bubble, or do you think this is happening a lot faster than what happened during the tech bubble?
Well, it's the tech bubble in that people are just chasing price rather than anything fundamental. So from that perspective, it is, and it's a mania like anything else, and certainly the tech bubble was a mania in itself.
Yeah, I'm getting lectured by people who have watched a couple YouTube videos, and there's all the, like you said, there's all these additional new cryptocurrencies, and we don't, this is still an experiment, you know, with Bitcoin and all these cryptos, so we don't know which ones are going to end up winning, but people are basically gambling, and there's literally people out there who have watched a couple YouTube videos and they're gambling on a, you know, I don't know how much money they're putting in, but I think some of them are maxing out credit cards to gamble.
Yeah, that's happening left and right. I'm hearing that almost every day, stories like that. And people, again, this is people just chasing price. They have no idea what they're buying. They're just seeing things that go up that has crypto in the name or you know, digital coin in the name. And that's, you know, we know how those typically end. But like I said, it's a mania, and it'll go until it doesn't.
Switching gears, what worries you the most about markets and the global economy? Is it Europe and the European bond market like you talked about?
Yeah, it's that and how U.S. markets handle this quantitative tightening. Again, QE just lit off fireworks, and I can't imagine that QT would not do the opposite. Not necessarily in a symmetrical fashion, but rising interest rates in an over-indebted economy, at the same time liquidity being drawn away, will matter, and it will matter a lot. I just don't know when and from what level. But that's what typically ends bull markets, something that I think people should not be ignoring. I understand the excitement about the economy and the tax cuts and global growth, but again, it's typically central bank monetary policy that typically stamps these things out.
When I talk to professional value investors, they tell me they're having a difficult time finding long positions at reasonable valuations, but they're having you know, plenty of opportunities to find companies to short. Are there any countries or sectors or industries you like right now that are pretty much fairly valued that you think are maybe an interesting bargain based on what the central banks are going to do or how the markets are acting right now?
Well, unfortunately, most markets have had great runs, and it's hard to find things that are cheap. I still like emerging markets more because of the growth and valuations relative to the developed markets. So I've been a bull on India, even been bullish on Chinese stocks, and you know, even positive on some other Asian emerging markets. And I've actually begun to warm up to Greece as a market that's been that's down 85% since 2007, and has been completely washed out. And there could be political change this year for the better. Most of the developed markets are obviously very rich, and they can stay very rich, but again, combining that with removal of monetary accommodation, valuations do begin to matter.
Yeah, it's very interesting about Greece. I have some friends. I just watched the Real Vision TV video about that, and I read about that in their newsletter. Isn't there there's a political party that just took over control of Greece, and isn't it more socialist, though? So people are worried about private property rights there now.
Yeah, so my bet on Greece is really on the belief that Kyriana, I mispronounced his first name, but Mitsotakis is his last name, that he is the leader of the New Democracy Party, and that he is, I think, will most likely win a early election. And he's very business friendly, as opposed to Tsipras, who's in power right now, who's basically left of Bernie Sanders. And if Tsipras wins, that would be a tremendous game changer for the Greek economy that has gone through literally a Great Depression.
I think they've bailed out their banks a couple times already. I was reading that I know India is planning on doing additional rounds of bailouts for their banks as well. It just worries me, you know, when you're seeing multiple rounds of bailouts, how the bankers in these countries haven't learned.
Well, yeah, human nature is tough to change.
What's your opinion of this rally in copper, base metals, oil? Do you think this is fundamental based? Is it mostly a short squeeze, short covering rally? What's your opinion on this?
Well, I think people should understand that the precursor to this rally in commodities was that now is being supposedly driven by better global growth, which I think partly it is. Over the last 2 years, there's been a dramatic cutback in mining investment. So you've had, after the bear market, which began in 2011, at least in the industrial metals, well, by early 2016, you started to see a sharp reduction in mining investment. I mean, even in China, they're shutting down inefficient steel plants, and they've cut back production in coal and copper and a variety of different commodities. So that's what ended the bear market in commodities, was a cutting of capital spending. Then now you're seeing a demand kicker on top of the crimp in supply, and that's why you're seeing this rise in prices.
Yeah, I think gold was up 13% in 2017, so it kind of had, a stealth rally that most people didn't even notice. And, it could end up rising even if the dollar continues to rise as a safe haven play, especially if volatility starts to pick up again. But the gold miners, they were at a point, Peter, where if the gold price hadn't if it had gone below $1,200 an ounce, there was going to be huge supply problems. So I was expecting a gold rally in the near future. If it didn't happen last year, it was going to happen this year or the year after.
Right. No, I agree. I think gold has certainly turned the corner.
Yeah, silver hasn't really turned the corner yet, but gold has.
Well, yeah, it's lifted off its lows, but yeah, I mean that will eventually get going, and I'm pretty positive on that.
Well, last question before I let you go. Has President Trump done anything you like so far, and how would you grade his presidency so far after about a year?
Well, I'll break that into pieces. I'm certainly happy with the cut in the corporate tax rate. I'm happy with the cuts, or not necessarily cuts, or at least limiting the expansion of regulations. I think that is a big positive. I'm not happy with how they financed this tax cut, because they didn't cut spending. All they did was raise taxes here to cut taxes there. I think that getting rid of the state and local tax deduction is a form of double taxation that will be a negative in some higher tax states, which happens to make up a third of the U.S. economy. So I would give him, I guess a B plus. It would be an A if it wasn't for that elimination of the SALT deduction. And then everything else, it's a lot of drama and personality, and to me that's more just entertainment than something that will affect the average person here.
Yeah, the mainstream media is not dealing with that well, with all the tweets and all the other stuff. They're calling him deranged and crazy, and it's kind of ridiculous. But I think there's a method to his madness. So.
Well, I don't know. I don't know if there's a method to it or it's just something very ad hoc. But either way, I think the average person focuses on having a good job, having a good salary, and putting food on the table for their family. And Trump's tweets aren't going to impact that.
Yeah, I agree. The other thing is healthcare. That's a main issue for regular people on Main Street. But I think Trump is probably, it could backfire on him for him taking credit, for this large stock market rally.
Well, yeah. I mean, his having a Republican president in Congress, again, on the tax and the regulatory side, has certainly been a major boon to markets and should help the economy, again, all else equal.
Well, I think the central bankers, with all the liquidity leakage that we talked about earlier in the interview, I think they deserve the credit for the stock market rally more than President Trump. Because remember candidate Trump, before he won the election, was the stock market's a bubble, Janet Yellen's manipulated interest rates artificially lower. Now President Trump's saying the exact opposite.
Yeah, of course. I mean, it's the campaign, it's governing versus being a campaigner. Yeah, no question about that. He said it was a big, fat, ugly bubble, which, yeah, it is. But, he was able to take it into extra innings with his presidency.
Yeah, it'll definitely be a lot more drama. I mean, obviously, the Department of Justice and the FBI stuff is just crazy. Hopefully that gets fixed. I live right outside of D.C., so you can't even say anything nice about President Trump in public still. So that's how bad things are. I mean, I didn't vote for Trump, but, I when he does something good, I do give him credit for that, but you can't really say that in public right now. That's how bad things are in D.C. still.
Yeah, no, understood.
But Peter, I want to thank you for your time today, and please tell our listeners more about your newsletter, The Book Report.
Yeah, so The Book Report is a subscription-based website that subscribers can get my daily global macro market and economic analysis into their inbox for a pretty cheap price for the amount of content that I produce. Very
good. And if you had to make a couple major, last question, if you had to make maybe a couple predictions for 2018, how would you summarize then what you expect in 2018? Maybe more volatility or something along those lines?
Well, yeah, and I think it'll be central bank driven volatility as they get deeper into this monetary tightening. I think fiscal policy dominated the headlines in 2017. And I think 2018, it's going to be more central banks. Again, it's because it's not just the Fed. It's the ECB, and it's potentially the BOJ, and it's going to be the Bank of England that's going to raise, and it's going to be other central banks that are going to be taking away this punch bowl. And to me, that's going to be the story of 2018, which certainly will lead to higher volatility, because the reverse led to certainly a large suppression of it.
Well, that could potentially blow up that overcrowded, leveraged, short volatility trade on the VIX and the other stock market indices that's gone on Wall Street and pretty much all over the money management industry. I mean, I've heard stories of European pension fund managers that wouldn't put a dime of their own money into that, but they're putting like retirement money for their clients, large European pension fund monies, onto that leveraged short volatility trade.
Yeah, I think we know how this typically ends. It's just a matter of when and from what level.
Well, Peter, I enjoy your insights. Keep up the great work, and hopefully,
thanks so much for having me on.